40% of those are saying if they don't change anything, in 10 years, their company will not exist anymore. We have the highest interest to EBITDA ratio in Europe.
When I started 15 years ago, 3 times leverage in the automotive industry was refinanceable. Today, people are looking at that differently, simply because there is not that much financing around for the automotive industry in Europe.
Welcome to another episode of Fixed and Floating. Talking autos is always emotional in Germany, and for me, it's especially personal. My dad worked at BMW for close to 40 years, so we are very much a BMW family. That's why this discussion feels a bit like Americans talking about the Rust Belt, familiar, loaded, and full of history. And it comes with bittersweet feelings to discuss what is probably the most contested sector at the moment in Europe. I'm very pleased to welcome Daniel Steiner from PWC and Hendrik Hauke from Willkie to unpack the auto supply industry from both the operational and legal angle. Welcome to the show, both of you.
Thank you for having us.
Could you give listeners a bit of background of what you both do at PWC and Willkie?
Well, welcome as well from my side, and Joseph, thank you very much for having us. My name is Daniel Steiner. I'm leading the Performance and Restructuring team in Germany, and as well, I'm globally the Automotive Performance and Restructuring practice. My daily job is actually helping automotive companies transforming themselves into more profitability, securing their future, and also performing in a better way.
Also, very warm welcome from my side. My name is Hendrik Hauke. I'm a restructuring partner with Willkie in their Hamburg and Frankfurt offices. I've been heavily involved in the automotive restructuring sphere during the last, more than 10 years now, with a lot of large names, starting with Neumeier and then later moving on to Benteler, LEONI, IFA. So a couple of names that are well known in the market. We get involved most of the times when Daniel is already on board, trying to find solution prior to an insolvency, but also advise investor in insolvency cases. So we see the whole range from a pre-insolvency restructuring up to distressed M&A processes following an insolvency.
3 years ago, you both did a TMA Europe panel literally called the German automotive sector one big restructuring case. With a question mark. In May 2026, is the question mark still there?
Yes, absolutely. And frankly speaking, when Hendrik and myself were actually talking about that 3 years ago, the market resonance was having a question mark on that. And looking to where we are right now, we are in the perfect storm. So therefore, I would say even more than we actually were forecasting 3 years ago. Why? Because transformation was actually really accelerating by technology, and as well when we're just taking a look to the geopolitical tensions and as well the costs behind that, it's absolutely accelerating their transformation, and therefore absolutely we are in a restructuring. We are in a restructuring where we don't see top line growth anymore, where we actually see cost explosion there in the material cost and also labor cost, and overall a higher competition than actually we thought a couple of years ago.
Yeah, for me, it's more of an exclamation mark now and no longer a question mark. The cases tend to stick around much longer than they used to in the past. It's quite difficult to find solutions. And what we didn't see during COVID is automotive suppliers to a larger extent going into insolvency. And I guess there's quite a lot of trend in that direction during the last 2 or 3 years.
Just to set a scene quickly for our listeners, how many active mandates do you both cover on auto suppliers at the moment?
It's a good question, and let me say it like that. When we're taking a look to actually our overall our split by industries, it's more than 50% of the restructuring mandates are right now automotive mandates. And looking to that, there are names from the big names, which everybody somehow expects, but as well as smaller names, which are as Hendrik said, I'm going pretty fast right now into insolvency. So therefore, we have a pretty big range. I'm covering actually right now the automotive industry.
Yeah, for me, the same applies as for Daniel. I'd also say like 50%-ish automotive or related matters. So all about the industrial landscape in Germany and, of course, Europe. They are hardly ever local, but global players, even if you do not know the names. What we've noticed during this year mainly that hardly any new cases are coming in. So it seems like people try to stick out the current situations and hope that things go away. They never do, but this is my sentiment right now that automotive suppliers do not really want to go to the market and say, well, we are a restructuring case. I don't know, Daniel, whether you see anything else, but this is what we noticed during the last 5 months, I would say.
Absolutely. Hendrik, I can just emphasize that. I'm looking to that, what has changed also 3 years ago, Joseph, to your question also. When we were talking about that a couple of years ago, there was still the expectation for a top-line recovery. So we see right now that we have recovered to the value at the top line of 2019, but therefore right now we see actually no growth in the regions. We see actually also with that a very difficult transformation because we have to ramp up 2 technologies in the same time. And in that regard, we see also that this is a very struggling situation, a challenging situation for the automotive suppliers who are already in restructuring, but also who are trying to refinance themselves on the market. It gets more difficult than it was 3 years ago.
Daniel, you shared a deck with us in advance to this recording, and there are like a couple of numbers which really stuck with me. So it says that 40% of automotive CEOs say their company won't last another decade on the current path, and 72% of European suppliers are signaling performance improvement needs, and a third of them explicitly is in the distress category, as you categorize it. Could you walk us through what that distress actually looks like at the company level?
Absolutely. And I think it's interesting because we're elaborating and evaluating these numbers every year, and it has changed. It has changed also to a sentiment which is more a structural problem than a point in time. And this has actually also changed when we're taking a look to the numbers. Just highlighting, 40% of DOs are saying if they don't change anything, in 10 years, their company will not exist anymore, which is a very tough message. And with that message also, it goes hand in hand that the restructuring is one of the key elements to actually survive right now. Only restructuring the bottom line doesn't work anymore. So we really need to restructure also the top line, which means as well innovation and restructuring needs to go hand in hand. Second, when we're taking a look, for example, to the distressed figures there in the market, you can interpret it from 2 ways. Absolutely, more than 70% are distressed. What does it mean? They have already problems to refinance themselves. They are actually under pressure. 70% doesn't mean that they are going tomorrow into insolvency. But the message is we are somehow right now stabilized the situation, but on a very high distress level. So therefore, this is as well when we're taking a look to the market, which is they're very clear that perfect storm is actually not anymore like single restructuring cases as it was like 5 years ago. Right now, we see this as a structural problem from the branch. And looking to that, I think we see that also very clearly in figures. For example, in our last strategy end paper, where we actually see that we have the highest interest to EBITDA ratio there in Europe, which means all the other regions have actually advantages by accessing capital compared to Europe, which also indicates very clearly that this distress number will actually be stable on a high level for next month and years. But we really need to overcome the next 3 to 5 years because this is actually the timeline of the transformation and restructuring. And after that, I'm also very optimistic that we can master that.
If you are getting value from fixed and floating, there's even more waiting for you on Substack. We publish written analysis, deep dives, and extra content you won't find anywhere else. Head to fixedfloating.substack.com, subscribe for free, and come take a look. And now, back to the show. Is the stress mostly sent in the tier 1, tier 2, or even the sub-tier ranking of the supplier base?
That's a very good question. And frankly speaking, first tiers are exactly affected in a more shorter time frame. Why? Because they are directly also with the OEMs in the supply chain, they're affected directly. But going to the second and third tiers, and Hendrik, we were actually also working very intensively on second tier base, because in the second tier base, it came actually a bit later. So we saw actually a couple of months delay in the distressed figures in the second and third tier branch in the supply chain. What we see is also that the smaller ones are actually somehow going faster into insolvency, because they did not have the transparency. The transparency also, when we're taking a look, for example, from a risk management, where I'm supporting them to somehow restructure them to profitability and stability again. And in this regard, we see actually that a lot of small suppliers in the second tier base are actually going faster to insolvency than the first tier suppliers.
I think that mirrors as well what we've discussed with Hendrik in our pre-call, when he said that there is too little happening at lower supplier levels. So you have the classic Mittelstand cases with 100 to million, $500 million in revenue, which have raised financing during COVID and still have decent liquidity, and maturity walls haven't really hit. But below 100 million, we do see quite a lot of suppliers going straight into insolvency. Daniel, do you recognize that picture as well from the operational side?
Yeah, absolutely. Also from the operational side, we see this happening exactly like that. And I think one point is really, first of all, the focus in the market, that the first tiers have more transparency on that, and also the stakeholders around that have more transparency and can actually intervene faster into restructuring, which, frankly speaking, is something over the last years which worked pretty well in stabilizing their supply chain. So the tools, they work, but also they need actually to have the right time to interfere. And this is, I think, exactly the challenge there with the smaller suppliers, and as well with the second and third tiers.
Yeah, and I guess one additional point is as well that the tier ones are so deeply embedded into the supplier network of the OEMs. The relationship is so close, whereas with the second and third tier supplier, they are more supplying only to the tier one supplier, so they are falling off much easier than, let's say, one of the larger tier one suppliers.
Absolutely. And maybe adding on that, Joseph, because that's a good point. Also, one thing is that the first tiers have actually more transparency in what is actually globally right now going on with technology, with trends in the automotive market, and can also react faster. And their product portfolio is usually wider. And with the second tier suppliers and the smaller ones, they usually don't have actually those insights globally. And this we see also when we're taking a look then to strategies, that their strategy somehow doesn't have the overall picture being reflected, for example, as a big first tier supplier deeply connected into the OEM supply chain.
You used a very nice diagram. I very like that. It's the tier one sandwich, top line pressure from volume cuts, underutilized factories, OEM call-off fluctuations, and regional demand shifts. On top, you also have bottom line from energy, materials, transport, personal costs, and financial distress. So which side of that sandwich is the most relevant in 2026, and how has that shifted over the last couple of years?
It's a good question. And I'm just imagining that picture. I think, frankly speaking, if you put a tomato in between that sandwich, the tomato actually maybe also gets on your shirt. So therefore, we have to be very careful, because the pressure right now from both sides are increasing. And a couple of months ago, probably, let's say like before the Shanghai Auto Show, I would say the pressure from the cost line is actually in that regard bigger, because what we see is raising material costs and labor costs are increasing, and as well the productivity and the efficiency is going down, energy costs as well. But looking actually to the last month, I even would say that the top line pressure is one of the things coming from the top, like the OEMs. If we're taking a look just to the profitability, that they are right now as well under pressure, that actually the profitability is not anymore in those spaces as it was during the COVID times. So therefore, we see actually a overall pressure in the whole supply chain. And as well, by the way, also with the financing. So therefore, I think something is very clear. And when I was speaking to one of the really influential CEOs, he very clearly said, well, we have one big topic. The supply chain overall is something, and this is where we all have right now our issues, and we need to work on that together. And this is something everybody says over the last years, but I think this has really changed, because if you look back to the years 2017-18, their automotive suppliers had actually a very good earning, and they were earning more on average than the OEMs. This has changed that picture, because actually with COVID, the supplier profitability went from 7% down to 4% in EBIT. And in that regard, in the same time, the OEMs were actually increasing their profit during COVID. You remember everything, the supply chain shortages, and with that also the prices were actually be able to rise. And right now we see actually since a year we see a trend that both profitabilities from suppliers and OEMs are declining. So therefore, right now the pressure is in the whole industry. And with that being said, I think the pressure also comes with, because we are right now financing and operating in two systems, ICE and BEV, with the two technologies. It's right now really one of the key challenges, especially for us in Europe, to be efficient and also profitable with those two technologies in the same time.
I think that's a very good point. If you look at these two technologies, so you have like let's say a 2026 BEV versus a 2016 ICE model, what content is generally gone? If you're talking of an exhaust, fuel system, classic transmissions, these are the easy ones, but what else is in there which is gone from a content per vehicle point of view?
Yeah. And so our industry was very, very good in the exhaust system, and also with the supplier base, nobody could beat the Germans. It has very much changed towards it's all about batteries. Batteries cost is actually one of the biggest drivers there for the cost per vehicle. And with that, right now, the Chinese supply chain is there actually set up in a very stringent way. What does it mean? Cell production till the battery production is, for example, at Chinese car makers, deeply integrated into their supply chain. And if we're taking a look just to the cost per batteries, how it actually decreased over the last years, there it came also the question up: is this the new commodity? I don't think so, because when we're taking a look, it's a big differentiator also in the car. People are right now, when they are buying an EV, the big question is, what is the mileage? How actually how fast can it charge? So therefore, there's actually going the big portion of the cost per vehicle into. And by the way, also this defines with the battery access from the supply chain very much there the profitability of the OEMs and also from the supplier standpoint. But on the other side, if we're just taking a look then to Europe and China, the comparison in Europe, we have actually missed the chance for building up over the last years the battery production and the battery supply chain in Europe. Why that? Technology-wise, the Chinese are actually in a pretty good shape. And also, if you just take a look to one famous company, which was very much in the newspaper, which were actually then going into bankruptcy. Also there, we were not able in Europe to actually ramp up their technology. There's also one reason for that behind, and I'm looking to that as one of the many reasons is also where do we put our capital and our focus to. China was very clear. China had a very clear strategy in First, we will build the EV car until 2025, and then till 2030, the smart car. One CEO from a Chinese OEM brand said to me a couple of months ago. I think that's a clear strategy. And this we missed over the last years. We were somehow really in this point where we need to manage two technologies in the same time, need to manage two supply chains in the same time, and just looking to where we are from a profitability point of view, almost every supplier is right now struggling with the profitability of their EV ramp-up technologies. And this is, I think, really one struggle, that business cases did not work out. And in that regard, also the financing and the capital access is actually, they're very much under pressure. What do we see right now in the market? We see for sure more and more M&A activities, but the big question is who will buy that? And with that, who is buying that? Again, there's the question, is it going actually then out of Europe, where right now a lot of capital is actually also being injected? Or are we able to build up the supply chain for the future also in Europe by ourselves? And I think that's a race, and we have lost a couple of years.
Very good points, but I would say some of the distress in some of the supplies isn't really a margin problem at all. It's a portfolio problem, right? As you said, the content per vehicle is drastically changing, and some parts are simply disappearing. How would you say you sort between this is a turnaround and this is a managed wind down for some of the companies?
Yeah. So just to make one point clear, yes, it's portfolio driven. And the question is, when do we actually do not need any more of that portfolio? And what we have seen over the last month, also with the ICE change, ICE is living longer, and ICE is at the end profitable there in the market. But therefore, the big question is, are you having a technology which is actually important for the future? If yes, that's definitely a turnaround case. Second question for me is, do you have actually a stable and also reliable shareholder structure, which actually in that regard also is supporting that turnaround? Absolutely, that's one of the keys. And the third point in that regard is also, do you have actually the capability to turn it around? Because do you have right now the right setup, and as well, do you have the right production footprint, for example? One of the key points is we see right now too much underutilization, and I would not say we are everywhere need to wind down, but what do we need in the market? We need a consolidation. We need a consolidation, which is in that regard also like in a Tetris play, where you're shuffling around there the blocks to actually build there a more efficient system again. And I think this is something where we actually need to come as an industry in Europe towards that with the deals, we actually can then reshuffle the portfolio, and then also some part of the portfolio will go away and they will be wound down because they do not have the future existence. And some part of that we actually need to wind down for a longer time, because actually with the ICE living longer, we also see that we will have there some capacities being needed there in the supply chain, which by the way is also very cost intensive to actually keep that alive. So therefore we need to be also cautious about finding a way on how do we wind it down. And I think there's pretty good ideas there in the market, where right now a lot of OEMs, first tier suppliers, lenders, advisors, everybody are discussing about what are actually possibilities for the consolidation for this wind down. And Hendrik, we spoke quite intensively as well about that. One big point about that is the antitrust. If we are overcoming the antitrust topic, and if we find there a way to manage that, I think this would be a very big game changer there in how we can consolidate there and reshuffle the portfolio in Europe.
If you stay with the portfolio for a bit longer, where's content actually growing? So obviously battery management, but also ADAS, power electronics, thermal, SDV. Where are these pockets of value, would you say?
Yeah. So the pocket of value is changing dramatically from hardware to software. And just one example, when I was in China a couple of weeks ago. I was speaking to one of the leading CTOs there in the market, which is right now in almost every vehicle. And what they are saying is, we don't have any interest right now in producing the vehicle by ourselves. We would like to have the software. And with that software part, they're actually increasing dramatically also the content per vehicle, but as well the costs per vehicle. They're reducing that very much. Because if you're looking to an ADAS stack, in the past, or as well from Western suppliers compared to Chinese suppliers, they are probably almost 10 times the price as it is right now being offered there in China. And the technology works pretty well. I tested that as well there on the streets. So therefore, there's really the change from, are you producing hardware towards software, and the software actually will define there way more the content of the vehicle. Also, if we're taking a look to NVIDIA, which is right now very much putting a focus towards physical AI, bringing that into the car, which is changing dramatically also the architecture of the car, but as well in that regard, also where's the profit being shared. And there, if you're just taking a look to some news there in the market, which are public, you see as well that the sharing the profit is actually there changing very much, not anymore in the supply chain, how much do you actually deliver. They're actually going more also into the pricing model and saying like, well, of the profit, we're getting actually also a part of that deal. So this is something what we're seeing also in the software architecture in several companies right now, rethinking also the value, but also the pricing model.
These are also very, very interesting points. If you stay with the software stack, so I'm getting more and more the impression that much more of the value creation is going back towards the OEMs, so especially with the new EE architecture. What is actually left for the supplier base if most of the software stack is going back towards the OEMs?
Yeah. So what is the strength of a supplier? A supplier needs to have a technology the OEMs either can't actually produce, can't develop, or they don't have actually the scale to actually do that in a proper way. And when we're just taking a look, for example, to chassis and to other component supplier, I still have a strong belief that they will be needed also in the future. Why? Because the scalability and also technology is something right now the supplier in that regard has very much with itself. Also, if you're taking a look just to components like technical components in that regard, which are important for engines and also for some battery supply, they still will lack with the suppliers. Why? Because they have the possibility in that regard, focusing on that technology, focusing also on scalability across multiple OEMs, and also what we see as well, for example, in interior, what has changed very much over the last years, that interior is something which is not highly technology, but interior is something in that regard, how you actually design the interior has also changed the way the OEMs are right now designing the car. And OEMs are also depending on the development and innovation by the suppliers. So therefore, innovative suppliers in the market who have also the capability for scaling up technology and innovations will still have their portion and maybe even increasing their importance in the supply chain.
You mentioned it at the very beginning. OEM margins are also very much under pressure. Where in the OEM P&L is still a real margin, especially also with premium brands are coming much more under pressure in China as well.
Yeah. Glad that you mentioned China, because I think this is the big game changer. When we were taking a look for the Western OEMs, there was actually already a couple of years ago a big trend. The Germans were actually going more and more into China. The Americans were actually somehow stepping out of that market. Also, the Japanese in that market were actually not that strong anymore and declined also. But we as the Germans were somehow really dependent also in the overall profitability from China. 30 to 40% of the profit were actually coming there from China, which is in that regard for sure a super important market. But it has changed. It has changed. If you're just taking a look to the sales in China, the German OEMs by itself, they dropped from 25% to almost 30%, roughly 15%. So they really lost a big share of that market. And with that share of that market, for sure, also there was a big profitability loss. Looking to that, we actually had products there in the market which were good, but in that regard also very, very big competition there from China. From China, we see right now more than 100, 150 OEMs. It depends on whom you are really counting, also from the smaller ones, but it's immense what is actually going up there. And if we're just taking a look to that market, we see that market is right now focused very much there on EV. And for them, it's easier to actually ramp up that technology because EV, the complexity has gone in some parts out of the car. We as German OEMs, we were super strong in building the perfect ICE. And I think nobody could beat us. But with changing that technology, this was also a chance for other OEMs and entrepreneurs to ramp up that very fast, because if they have access there towards the supply chain, if they have access to batteries, then they can also build a car. And they have somehow copied not only successful models from the past from Germans, but as well from Tesla. They are thinking that car also from the software point of view. And I think this was a big game changer with Tesla already starting there in the 2015s. We realized that very much there in the market also as end consumers. And I think this is something which has changed how the car architecture, how the car is actually built up, and also how the customers are actually looking to that car and where they are actually willing to pay some price. And in China, if you're staying there 2 hours in the traffic jam in Beijing, your interest and your decision point, which car you would like to have, is different as if you're driving with 200 kilometers per hour on a German highway. So therefore, the global cars somehow are really under pressure, build a car for the global market. So therefore, this is also something which we see, it's more going regional. Therefore, in China, if you're just looking to the exhibition and to the new models, they're very much focused on the interior, not on the driver by itself, but also on actually the rear seats. Because a lot of people are having their a driver in China or going more to level 2++. In that regard, for example, things like that you have a beamer in your car gets more important than actually having at the end the biggest horsepower. And this has changed. But I think looking to that, it has changed also how we as Western car makers are actually looking right now towards China. And if we're just taking a look to the newest developments there in the market, I think we are back as Germans. The products which we're right now bringing into the market are very competitive by price, very competitive also if you're just taking a look to the technology, to the interior. It's really high quality. And I think this is something which is in that regard a big game changer.
Just taking a quick pause here. If you're finding this breakdown useful so far, please forward the episode to a friend in Creditor High Yield who should probably hear this. Also double check that you are following Fixed and Floating so the next episode drops straight into your feed. Alright, let's get back into it. If you think about utilization across various jurisdictions, so if you think about the three most important ones, Europe, especially Germany, the US and China, could you give us some numbers around the utilization across OEM and also suppliers?
Absolutely. And if we're taking a look to that market, Europe, we see 25 to 30% overcapacity. Right now, I would even range it more to the 30%. The numbers which we evaluated were a couple of months back, but therefore, let's say 30% we see in Europe right now. When we're taking a look to China, it's getting even more dramatic. In China, we have about 50% overcapacity. In North America, the capacity is in a better use. Which why? Because there was already a consolidation. So if we're just taking a look to the free region, and what does it mean? Europe, we have a big issue. If you're producing with 30% underutilization, your plants are actually not anymore operating on a profitable level, which is affecting the OEMs, but also which is affecting very much the supply chain of the suppliers, because we should shut down some plants also in the supply chain to actually consolidate the capacity again, and also in that regard produce at the optimal point of costs. But it's not that easy. Why is it not that easy? This is due to how do you consolidate the supply chain if different customers are actually not coordinated. One of the topics which is for sure a big challenge in who is stepping out in which supplier and where do we actually consolidate that amongst the supply chain. I think this is the big challenge there in Europe. How do we actually consolidate the market? In the same time, the Chinese are coming to Europe, buying factories, building actually factories, and also the suppliers by itself also. So we have in Europe overcapacity plus new competitors entering that market. Just looking to China, 50% overcapacity. What does it mean? The Chinese market is actually designed not only for in-country production. This is designed for an export market, because that capacities you can only operate profitable if you're exporting there to foreign countries. Where did they start, and where do we actually see already that this is happening in an effective way? So if we're just taking the South Belt, like Latin America, Africa, and also in Asia, they're exporting pretty successfully their models over there. Why? Because they're also cheaper. Sometimes we see actually a price difference of almost 100% to some Western OEMs, which is in that regard for sure big price advantage what they have. But second, also right now we see a big improvement already in Europe. We have about the latest numbers, 10% of the new cars being actually they're registered are in Europe right now from China. And if we're just taking a look to the UK, we have more than 15% there already in the UK Chinese cars. So therefore, I think that's obvious. They are entering into that market, and it's a big competition right now amongst that. Does it solve the capacity issue? No, absolutely not, because at the end, we are not selling more cars with that. And the numbers of cars in Europe is also not increasing with that. So therefore, it's a bigger competition on who is selling the car. At the end, there will be a big advantage for the end customer, but this is also something where the competition will actually, with the transformation, be important over the last years. One thing being said, looking to capacities and also to numbers in the automotive market. If we just cut off in 2018 and looking back to the last years, it's absolutely a big problem that we are not growing anymore in that way. If we're looking back to 2010, we actually still see a growth compared to 2010. Why that? Because if you remember back, in 2010, it started with, and also back in 2005, we were very successful in the export market as German OEMs, as German suppliers. And with that, we built up a global supply chain, a global footprint, and we did that very successfully. But we were very much also focusing on that technology which we had. And with the technology change, somehow the stress into the supply chain came. And this is something where we need to react faster, react also more rigorous. And I think we see right now that this has come into the strategy of the automotive companies, which is good. I don't think it's too late. I think we still can overcome that challenge with the capacities.
As you've just mentioned, the footprint of the factories of the suppliers, one thing which is bothering me a bit is that usually you build your factory, your supplier factories next to the OEM factory, so having a very local approach. If you think about reducing the footprint of the suppliers, aren't you more and more mirroring the utilization of the OEM plant? And doesn't this make it much tougher for suppliers to really reduce their footprint?
It's a good point, and just zooming in a bit on that point. Looking to the supply chain in the automotive, we can separate amongst two parts: just in time and just in sequence delivery, which needs to be very close to the OEM factories. And the other ones, which are more the component suppliers, also focusing on technology, things like that, they can actually bundle their footprint more in a centralized way and do not need to be 20 kilometers around the OEM factory. And definitely this is also something which we see there, that this is easier for them to consolidate that. But there's one big change as well. The chip and chip suppliers are usually more human heavy, labor heavy, because they're assembling their parts, and the parts assembled in the right sequence, in the right order, needs to be close to the OEM factory. The other ones, they're very much they're machinery heavy. So therefore they have a lot of capital there being invested into machinery. So therefore for them, underutilization is in a different manner. If you're labor intensive, for example, if you're assembly supplier close to the OEM assembling their different components together, which you actually get again from other suppliers like interior, it's somehow easier to manage the flexibility if you have a volatility in the demand, and you can scale it down a bit easier. In the other way, if you have a big stamping machine, which costs you millions, it's not that easy to reduce that capacity that easy and to transfer that to another place. So therefore, we really need to distinguish those two archetypes. For sure, there are more, but simplifying that, I think those two things are very important about looking to how capacities can be managed there in the supply chain.
In our pre-call, we already talked very deeply about consolidation and issues around that. From an operations point of view, Daniel, what does the sector level consolidation looks like in practice if we set the legal questions for Hendrik aside for a second?
If we can sketch that on a white paper, I think what would be super important is defining which supplier is actually the chosen supplier for the future, and which suppliers also having the trust by the customers that they can actually really be the one in the future, or one of the twos. Second, this supplier needs to be super committed for restructuring and transformation. What does it mean? They need to be very transparent. They need to be very rigorous in how they are managing their costs to be actually really competitive, that they can overcome their the restructuring and transformational issues. And the third point is, in that regard, with that, they need to be able also to absorb very quickly and very flexible orders and parts from other competitors. How can they do that? They actually need to have a very good operational task force, which can ramp up production pretty fast. And this is something I think from an operational point of view, super important. The other point is we need actually a very good management in how do we consolidate that? How do we consolidate that from an M&A point of view, but also how do we consolidate that from the carve-out point of view? Because carve-out and merchant integration will actually become there super important with this deals, and this is actually then defining also how efficient this consolidation can happen.
Hendrik, and this is your first proper question. How can you consolidate the supplier industry without competition, anti-competition law getting in the way? Where does Kartellrecht actually bite, and is the Bundeskartellamt actually going to block the cure the industry actually needs?
It's a very interesting question, and I would split it up in two levels. On the one hand side, you have the wind down world that Daniel already briefly described, meaning there is a last wind down consolidation in the market with the last man standing in the market that will finally and eventually stop producing. So those guys have to be financed in some way. It's might also be an interesting investment case if at least the support of the OEMs is there to find those kind of solutions. Actually, Daniel and I discussed that already a couple of years back, that eventually we have to come to an agreement. We think that antitrust will allow for those special circumstances, because it's not about a monopoly in a growing market, but rather a solution for something that is there. And for the end customer, it's better to have the last man standing that not having that, because what is the end result of that you do not have any components anymore. You cannot fix your car anymore, and that eventually means that you have to buy a new one, which overall, of course, means not good for the end customer. So that's the wind down scenario. And when you're looking at the trends that we see during the last years, there's really a trend of consolidation. Mid-level or already larger suppliers putting their businesses together, getting new equity investments in. In that regard, I would say, of course, you have to look at antitrust, but eventually the overall market is still super fragmented. You hardly have this one player that holds 80-60% of a market share. You rather have, and I think this is also where OEMs are closely looking at, they do not want to make one of their suppliers too large and too big and too powerful in negotiations, but have like players that have like 15, max 20% of the market share. This then eventually means that antitrust may be circumvented when trying to find solutions.
If we turn back towards the operational side, Daniel, you just came back from China. If you would paint a picture, what does the ground truth look like in Q2 2026 versus what it looked like 12 months ago?
Technology is coming faster than we all thought. So we will drive in China, we will drive in 2026 already autonomous. In 2027, it will actually come there also towards the passenger cars, not only the robotaxis. And the same happening as well in America. So therefore, that's defining completely the car in a different way as we used to. So therefore, ADAS is coming. ADAS is actually not anymore that we are just having an assistant. No, at the end, it's really autonomous driving, and AI is actually empowering that. If you're taking a look also technology-wise, it's pretty interesting. Then level 3, which was in the streets a couple of months ago, will be completely different than the level 3 and 4, which we will see in a couple of months there on the streets. Why that? Because AI is a big game changer. With the models being actually now in the car, we see also that AI is changing completely how the car is actually being autonomously driven. First point. Second, EV is not anymore a question mark. EV is actually like already on a mature level. This is for me also very clearly taking a look to the technology there in China, but as well in Germany, that EV, you can drive it. You do not have to have fear about the mileages. You do not have to have the fear about the technology. The technology is on an absolutely mature level. But also when we're taking a look to China, in China, the customers are actually right now very much technology driven. So therefore, they love actually the car which have big screens and as well being thought out of the software. But for me, one big takeaway is, and on the way back, I had I had in the plane a couple of hours to reflect what was really happening there. And for me, it was very clear. We as the German OEMs and the German automotive market, we still have a good chance. Why? Because we have reliable products which are actually also being known for safety, which is in that regard, I think, a big game changer, because if you're a new player in the market, you don't have this history for knowing that. You just need to imagine, if you drive with your family in the car, is it more worth actually paying a bit less, or do you want to drive as well safely with the technology? For me, that's really one thing which is super important there. Taking a look to the choice of the end customer, but as well, we see the most buyers in China are first time buying actually a Chinese car. So they have not actually experienced there. What does it mean to resell the car? What does it mean actually in that regard to have the service supply chain in place and the real dealer network with the service level being in place? And I think this is something which not only China, but globally, where the existing OEMs have a big advantage, but they really need to use that. They really need to use that also in terms of reliability. And we see that happening. There also German players are becoming more Chinese. Development is happening in China because development is actually there the half of the time as it was in the Western world with new products. It's cheaper. It's cheaper because if you're just taking a look to labor, it's 3 times cheaper labor in production in China compared to Europe, and it's more flexible. And I think with that combined energy costs, things like that, it's more competitive building right now than in China. So a big takeaway for me is, yes, we can do it, but we really need to change also our structure here in Europe. And if you're just taking a look to one thing in Europe, if you're building up a new technology in Germany, it is a big entrepreneurial risk, because if you're going into that and the technology doesn't work, you need to pay high severance costs. You actually need to pay high costs for actually wind down, which you usually don't have in other markets where actually this, for example, is way more cheaper, as even in high cost countries like Switzerland. So therefore, I think we need to change some rules of the game, how we are actually working right now within Germany. And we can also learn a lot from how actually China is right now driving that technology speed and also that productivity reflecting then in lower pricing.
Back to the cost question. You mentioned before that German OEMs have done their homework with regards to pricing. What does it mean concretely, and is it enough to really sustain their share of the market in China and in the world for a prolonged period of time?
Yeah. So what does it mean concretely? They have actually shorter development cycles. They have really improved the development, and also they have developed the car with more focus there towards the Chinese market, but also in China. So therefore, they have also used the capabilities being existing there in the market, which is, I think, really one big thing. We see that in the latest models coming out. The latest models, they look good, but also they are good, and also they are price competitive. If you're just taking a look how much they have lowered their price, and also combined with productivity, it's impressive. But also, what does it mean? The car is actually in that regard more Chinese, also from the supply chain, because you have used more Chinese suppliers for that. If you're just taking a look to Huawei, things like that, they are in almost every car right now, also from the Chinese OEMs. And things like that is actually something where the German OEMs have actually gained a lot of speed. They have radically thought about how they are actually building the architecture of the car, but as well how they're building that car. And I think this is something what we really see there in the new products, which is absolutely a comeback. But doesn't mean that actually in that regard it's a comeback that they will actually get the market share which they had a couple of years ago. That's a big question mark. But I think definitely now we have again products there in the market which are pretty good. And if you're just taking a look, like 2 years back, I was standing there on the street in Shanghai and waiting for a cab. And if you're looking to the cars there on the street, it's impressive how actually the Chinese cars were looking pretty new because the development cycles were actually so short. So therefore, they brought up every time new cars. And if you're having there a development cycle which is twice as long, for sure, the car doesn't look with the newest model, newest interface there on the street. And I think that's actually the big game changer what we have seen there in the market.
In terms of margins from suppliers and OEMs, what is really puzzling to me is that you do see quite decent margins for suppliers in China, whereas margins are substantially lower in the US and even worse in Europe. On the flip side, margins for OEMs, especially the Chinese OEMs in China, are relatively low. So margins for suppliers surpass margins for OEMs. So I'm very puzzled for how long this discrepancy can hold on.
And this, I think, really the right question, Joseph, because I don't think it will hold for a long time. So what do we see? What we will see in the next 3 years? We will see a big consolidation in the Chinese market from the OEM point of view. With more than 100, 150 players in the OEM space, we will see in 2030, my guess, around 10 OEMs from China, which is at the end also normalization if we're looking to some other markets, Japan, South Korea, things like that, where there was also normalization by time, where we also see right now the OEMs, the number of OEMs is actually right now not that healthy for the market. Why? Because if you're a supplier, and this is the big question for suppliers, with whom I do make a business in 2 years, and are the volumes stable? In the past, it was super good. You knew exactly how a model was performing. If you're taking a look to a high runner model, you knew exactly this high runner model is also producing 500,000 pieces a year. You knew that already 3-4 years ago, and for the future. But this has changed. Right now, the flexibility is one of the big currencies right now in the market, especially in China, where you have those so many OEMs. You actually need to have the flexibility in the supply chain. But this will also affect the suppliers' profitability. We see also that this is more under pressure, and also that Chinese suppliers are actually entering with similar products pretty fast into the market and trying actually also to have this variety of OEMs also in the supplier base.
Just taking a quick curveball here and talking about the tariffs, they have been in the news again last week. So my understanding is that tariffs usually get passed on, so the tariffs on suppliers get passed on to OEMs, but the volume impact is usually the real damage. So we do see that North American production is down close to 10% year on year. What do you read from that engagement? How do you interpret that for the supplier base?
So for the supplier base, this is again that they're in the sandwich position. From the top line, low volumes, and from the bottom line, actually higher pressure towards costs, because also their supply chain is actually not being set up that they're producing there in North America. The most suppliers has actually over the last years being built up their factories in Mexico, shorter so cheaper labor, and as well in that regard there was a big cluster for automotive. But as well right now with the new tariff increases, this is actually for sure a big challenge also for them. And it comes back to the point, how close are you to the OEMs, but as well also how much cost do you actually pay. The interesting part is now the big question could be, why not building up their plants in the US? Frankly speaking, the most plants which I have seen in the US over the last years, and Hendrik, maybe you can also elaborate on that from your experience, but were not profitable. So Germans have actually culture-wise somehow had a challenge always to run factories in the south of the US in a profitable way, but also some other regions who are entering there into the US. So therefore, the productivity still is actually then increasing there the cost because it's lower compared to Mexico or some others. I think the main issue is also right now with the top line, you can actually not just decline the top lines. Therefore, you also work on the pricing on the OEM side. And working on the pricing on the OEM side, again, brings pressure into the supply chain because if there's less money which you earn with a car, for sure you somehow need to optimize your supply chain, which at the end also means we need to have a cheaper supply chain for actually being able to be competitive. Because we can now discuss about, is it a German car, is it an American car? At the end, the question is, what is the end customer buying? And for sure, they're also looking to the price. And if we are actually having there the price on a higher level due to the tariffs, it's exactly going that way that then they will actually buy the cheaper product. Tariffs is, I think, one point also which if you allow that personal note, Joseph. I think tariffs is a way to protect for a short time, but on a long time, you're losing actually technology capabilities because competition is good. Competition is good that you actually are thriving farther to being more competitive, being more innovative, and also to restructure your supply chain in a better way that actually it's at the end more optimized. If we are putting tariffs around that, it's like a wall. With that wall, it's easier for sure to be protected if you're inside, but outside, the development will be still faster. And therefore, if you're within that wall, not having the same speed as outside, after the wall is actually being reduced, you're having a disadvantage in technology. So therefore, this is something which is really important to look as well about tariffs. On the one side, also the big question is, do we actually need to adjust some rules if the rules in the global market are changing? Yes, also I think that this is necessary that if some others are playing in the market not anymore global, we also need to think about how we do actually there protect our industry.
Talking shortly about the Strait of Hormuz closure, I think that S&P took another 500k units out of 2026 global production in May. How do you think the production number will be impacted by a prolonged closure of the Strait of Hormuz?
Yeah, it's a good question. And frankly speaking, the big question is how long will it take? Because if it is just like a year, we will see that we will have especially the problem in the costs, but then a small effect there in the overall volume. And for me, it's actually not only an automotive question. It's actually a question on the global economy and also on the inflation by itself. Why? Because what do we see already there, for example, in other industries, right, like retail? The pressure is already there. The end customers are right now reducing their demands. So therefore, in that regard, we see actually right now a lot of restructuring cases coming up in retail. In automotive, you have a longer lead time for buying a car. Usually you have the lead time more to 6 till 9 months till you are actually really seeing that as the impact in the volume. So therefore you don't see actually the big volume impact, not yet. But what do we see? The forecast, as you were explaining that, it can happen that we have even a drop by 5% in the overall global volume. And this depends also very much not only how long does it take, but how fast can we actually, after the opening of the Strait of Hormuz, how fast can we actually resolve there the supply chain of the oil that we can actually, again, produce that way. And cost base, I think we see that very much there, not only in the first tiers, but as well second, third tiers, and going back to chemical plants, for example, as well. This is really like one of the main problems also for the supply chain. How much can we actually, first of all, get oil? And as well, how much can we actually then also for which price? And regions are affected differently. For example, the gas in India, we see that already right now with a lot of suppliers that this is already short. And with that, some growing regions for the future might have even there the top line damage faster than expected, because India is actually one of the growing regions and one of the hopeful regions for the automotive industry.
And what you're saying is that they can't get the feedstock to actually produce and produce in an economic way. If we turn sides a bit and look at what's working, so if I'm just talking about one example here, I think Forvia is doing a relatively good job under Martin Fischer. So they suspended their dividend, say they have a couple of cost products running. They did do the first real big sale in the interiors divisions at a sub-group margin, but nevertheless they were successful in selling to Apollo. That's the first real deal in suppliers for quite a while. If we tune out, not talking about Forvia, but just in general, from the operational side, what are some of the suppliers actually doing differently from the ones who haven't turned yet?
Yeah, I think I'm not talking only about that example, but for me, there's one message behind that. Private equity are interested, also private equity deals are actually getting back in automotive, which is interesting that we see actually also new buyers. By the way, this was happening already a couple of years back in North America. And if we take a look to why is North America already consolidated and different from the supply chain, that's one of the reasons. We have actually there are also private equities there in the market. But looking to that, I think what's clearly pointed out, successful companies in a transformation can be actually stronger after than before, because with a couple of points. First of all, they need to reset their strategy. What does it mean? Reset the strategy means where are the real capabilities to invest in, and where are the capabilities I need to restructure, which means actually for a global automotive supplier in that regard, it can be that one business unit, they're winding down, the other one, they're restructuring, and the third one, they're selling to actually then have new capabilities being freed up to the restructuring capability, which is more innovative, which is somehow really one of the key players or key differentiators in the reset of the strategy. Second, you can't solve it all by yourself. So M&A is becoming, and portfolio reshuffling is becoming a major capability for the future. What does it mean? You need to actively look out with whom do you partner, with whom do you maybe go into a joint venture, and as well with whom can you actually partner, or with whom can you make business in different regions, which is completely different as we had it over the last years, where we were more looking globally and trying to make big is beautiful. So therefore, this is something also important. The third point is capabilities. In some business divisions, you need to be very, very innovative. There you need to have really the right capabilities from a technological point of view. And in some others, you actually need to have a real supply chain capability, which is different also how you're managing your supply chain and your innovation. And this is something which is, I think, becoming more important. And coming back to the partnering, the big question is also, are you doing that by yourself, just for example, with AI, or are you actually cooperating? I don't think that building up all the capabilities by yourself is a successful way. So that you need to actually leverage what is already existing there in the market. And the fourth point is capital access. If you're taking a look to that, capital will be one of the major game changers. Do you actually have the right access to the capital market? There's one very interesting slide in our automotive strategy and automotive study each year. Where do we actually have the highest R&D ratio being spent, and where do we actually earn right now the most? We as German automotive industry, we have invested very heavily into technology, but the payoff was actually not there. We see that with the EBIT margins. So therefore, we need to be faster in transforming R&D ratios, R&D investments into real EBIT. What does it mean? We can't allow ourselves to have a development cycle of 3 to 4 years anymore. We need to be faster. We need to be faster in testing it to the market and giving actually also there the confidence then into the capital market that we can attract more capital, that we can actually really build up on those capabilities. And bottom line is, restructuring is not anymore an option. Restructuring is absolutely a must-have. If you're talking even with healthy automotive companies, they say we need to restructure our cost base, otherwise we will be not competitive there in the future. And what does it mean? We need to actually also look, what is the right SG&A cost? What do we have? Usually we are right now in Europe, we were set up for growth, so therefore we need to reduce that. We need to be more on a competitive level. Factory wise, some factories are actually not anymore on a technology, on the edge of technology. So therefore we also need to have investments into modernize those factories, modernize it also with new technologies, robots, but also we see already the first humanoids. They're working in the automotive factories, which is, I think, also a game changer where we can allow that in Germany to be happen. And I think successfully at the end, we also need to have the support of the regulations around that. Because if we are paying 3 times more energy costs than others, or even 7 times higher compared to Asia, it's absolutely a disadvantage there in competition. And we need to actually there also restructure how we actually have the rules of the game of automotive that we can play on an even ground field. And if we have this successfully done, internally within the company, partnering around, getting capital access, restructuring the cost base, plus having actually then the rules of the game being set, I think then it can be successful. But the first step is understanding that we have to work completely different and more restructuring more radical as we have done that in the past, even if we thought that we have already done enough.
Hendrik, if we think about what's happening in German or general suppliers at the moment, and if operational restructuring does not work and we need to resort to legal ways, if we assume we have like a very large German tier 1 supplier who is walking into your office with a maturity wall ahead and needs to restructure its maturity profile. You have a very broad menu. We can talk about StaRUG, Schutzschirm, Eigenverwaltung, a regular insolvency, or we could also move to an English scheme without naming any company. So when does each one fit?
Yeah, that's a very interesting question and a big part, of course, of our daily business. It really depends on your initial due diligence and the further due diligence that you're doing while you are in the process. So what does the finance structure look like? Where does it sit? What kind of jurisdictions are those company placed in? Meaning, where's the center of main interest, COMI? What position do the shareholders take? Do I have to take a framework where I have to cram down specific groups that are subject to some kind of plan, being it a StaRUG plan or an IP? What does the liquidity actually look like? Yeah, this is what people sometimes tend to forget. You only have the time that the liquidity is still there and that you can operationally run. And from that, you're trying to build a plan and a process on how to move things forward and to try and find solution on the way. I'm also a big friend of the actual argument itself. If it is a good one, I always see the likelihood that you can find a consensus solution. For example, on Benteler, we had a 3-digit number of creditors. And at that time, StaRUG wasn't around. The company had its Colmy here in Germany / Austria. Yeah, at least there were some of the shareholders sitting there. the holding company. So it was impossible to think about implementing a solution via a majority consent. So we really had to push for consensual solution. Eventually that worked. I think overall for all creditors, it was a success story. And those that didn't consent, we simply left them behind and told them to sue the company. Yeah. But that, of course, only works if you've a small number of creditors that are out of the picture. But as Daniel already said, on the operational level, you also know, on the legal level, you sometimes have to be drastic. And it's also a lot about trust. So we are big friends of personal meetings, meeting people in person, and also flying to the places where the people sit and talk to them in a meeting room. Yeah, that is still old school, but still one of the best ways to convince people of finding a solution.
Talking about the new tool StaRUG, or not so new anymore, my understanding is that it's really built for capital structure problems, so really solving the issues of, let's say, the post-2008 crisis, capital structure issues, but less operational issues, oversupply issues, which are dragging down the whole industry. How well would you say does that tool really fit to the actual underlying problem at the moment?
Well, first of all, we, of course, as German lawyers, think that it's a good tool, but what listeners have to understand, it's not a solution. It's just a way on how to implement a restructuring solution. And there you really have to combine the operational approach, the implementation of things that Daniel described earlier, and combine that then with the legal process and trying to find a solution. Yeah, but if it's well prepared, our experience has been that it can be well implemented, that courts in Germany are picking up with understanding what is actually going on. And always with a new process, people tend to get better and better over time, simply due to experience.
Of the auto sector StaRUG, so LEONI, VARTA, how many did generally solve the underlying business problem versus bought more 18 months?
Yeah, I guess LEONI is a very good example. Actually, the first one where StaRUG was really used on a large scale, 2.5 years more or less after StaRUG was implemented as a law in Germany. For 2 years, it was hardly used, at least not for those cases that people have in mind, meaning a large-scale restructuring of the balance sheet. And well, we as advisors to LEONI gave it a lot of thought, even before it became imminent, that we really need it. And some of the topics that to some extent were not fully addressed in the laws because it was a new one, we tried to think that through and to have our plan ready once it became necessary. And actually, there was a fully consensual deal with the Thai investor already signed, and also all finance documents signed with the lenders at the end of 2022. That then didn't go through because the investor didn't come to closing for various reasons. And then we really had to kick off this new solution. And as Daniel described, it was drastic. We cut very deep, took off, I think it was like 800 million of debt from the balance sheet, delisted the company, took out the old equity, got a new investor on board. And then there was some kind of upside sharing between the new investors and lenders. And actually, for the first time in years, it gave the company room to maneuver, room to breathe, because what we see, and that is often also regulatory driven in Germany, is a tendency to keep more debt on the balance sheet than sometimes is very sensible. So, and LEONI then progressed quite well from that. And at the end of the day, I think it's all about the restructuring, the commercial restructuring plan, that is actually good, and that you're willing to cut a bit deeper than you normally would do to just kick down the can down the road. And this is what happens at LEONI. And it very much showed the market that it's a very good tool, and very much kicked off StaRUG cases in Germany and really picked up. And now it's something that we use on a daily basis, more or less.
One thing which is unifying most suppliers is that they have a very global factory plant base. So if you're thinking about a German company filing, but some of the enterprise value is left in a Chinese JV or a US plant, or let's say in the case of Standard Profile, some plants in Turkey. What is actually recoverable? What is ring fence? What is lost? What can't be accessed also from a cash point of view? Could you walk us through how an experienced professional like you thinks about that?
Yeah, it's a very, very interesting and then a tricky one. At the end of the day, when you look at Chinese companies, it's always difficult to get cash from there to Europe. There are some ways around that, but in general, there's a lot of cash trapped in China. And also, when you're looking at it from a creditor's perspective, taking security in China is a very, very long process where you do not, at the beginning, can see how long this will actually take and whether you will be successful in really taking that security. So I've seen cases where the company has tried for months and months to get security in China and eventually was not successful. And well, of course, where we have advisors within our firm, of course, we would talk to our colleagues in the US, in London, France, and so on how they see capital maintenance restrictions in their own jurisdictions, and we do not have those guys on board. Of course, we have our group of friends with whom we work on a very regular basis. And what helps, of course, is that automotive, in most cases, you're always or often talking about the same jurisdictions. Yeah, so you have your automotive legal guy in Turkey, in China, in Mexico. So it's quite quick actually to get a first impression on the difficulties that you might be facing.
The mix, though, has shifted quite a bit. So it used to be a lot of German banks, more German bondholders, some Schuldschein often in the structure. But do we see now more US-based distress funds buying paper there, or how does this dynamic of more distressed guys now coming is changing the whole structure and the whole dynamic?
Yeah, as a starting point, I would very much share your view or your observation that standard corporate German banks have pulled out a bit, at least, from the automotive sphere in Germany. I guess it's probably something that Daniel also sees. Then we saw a tendency to more go into bonds. And when it comes to distressed funds, being it London guys or US guys, we see quite a lot of movement, a lot of investments. Is it good or bad? I think that's, for me personally, I think, first of all, it's movement, yeah? Because if you have your traditional at par lenders in the picture, they sometimes are not willing to take on equity or cannot take on equity due to regulatory reasons, given that they initially were invested at par. They also have to fulfill high regulatory standards, being it with authorities, but also at the same time, of course, within their internal institution. So if funds come in, that there's always a good movement. And the book actually opens up on how a restructuring solution may be found. Yeah, more to loan to own, which of course then delevers the company, leaves more free cash flow for the actual business, and then is then not used for paying interest and fees. And of course, those guys are also more willing to look at things more commercially, more like an equity holder. So PIC structures are more implemented as well, yeah, which in our scenarios, of course, also helps the group of companies.
One issue across the board is that multiples have compressed and are still compressing, and that makes it relatively tough to divest some of the business lines to delever their company. So if you're talking about the divestitures, talking more about the 3 to 5 times EBITDA range, whereas historically we have been a bit higher. Does that also change how a viable restructuring plan is implemented? Because what I'm just thinking, if you sell something and you can't really deliver, why sell it all? Because that would probably imply that you just need a debt to equity swap, and not just selling something at a loss and prolong the grieving period. What's your view there?
Yeah, that's also pretty difficult one. When I started back like 15 years ago, under restructuring papers, 3 times leverage in the automotive industry was always said to be refinanceable. Today, I would say, well, people are looking at that differently. Yeah. Simply because there is not that much financing around for the automotive industry in Europe. It's more difficult to refi. With that, you have higher costs, which means that a lot more cash flow per euro refinanced actually has to be turned over to creditors. Having said this, so perhaps people say, well, 2 times EBITDA is still refinanceable. But that then, of course, also means on the equity level that the multiples paid are not as high as they used to be. And at the end of the day, it's also reliability in your business case. And as Daniel rightly mentioned, it's currently shifting. And then there are a couple of options at hand, yeah, and those are determined by how much do you pay for your financing structure, yeah. If you're paying, I don't know, for every euro, 12-15% in total interest, then even a sale for 3 or 4 times might be of interest because it simply takes down the debt burden. And but if you still have liquidity available, of course, the solution might also be to try and stick it out. But as a restructuring guy, waiting normally never helps. Yeah, and those matters tend to come back. What we've seen is a tendency in the market to take on even more debt with very high interest rates and cost rates for that financing. And well, quite obviously, those cases might tend to come back in the future, simply because the margin is, if you're good, it's like 8, 9, 10% EBITDA margin. And if your financing costs are 13%, somewhere, you have a breaking point there.
Each of you, just one quick minute. One thing the market is still getting wrong about European auto suppliers.
It's about speed, it's about flexibility, and it's about innovation and restructuring. If we don't get this in the same parallel way forward with full speed and full capabilities, we actually will have a problem in the transformation. If we master those 4 topics, I'm pretty sure that we in Europe, we still have actually in that regard our right to win, and we can win that. But this is something where we really need to be somehow different in how we behave, how we act compared to the past 10 years.
Yeah, I wouldn't say about the market getting it wrong, but the focus of the market more going into the consolidation direction, because the matters that I've seen during the last 2 or 3 years, and there are very successful names out there, those around pretty successful consolidations, put together businesses that work quite well together. So it's really a question of getting back to economies of scale, and on that basis, then moving up the profit margins.
And maybe, Hendrik, on that point, flexibility means also something a bit different as in the past. Flexibility is not only operationally, flexibility means also in how do you actually be able to make a deal? What does it mean? In the last years, big is beautiful meant actually over the last 10 years, in some companies, we did actually delve more into a big corporate structure, which was not ring-fenced. Right now, ring-fenced and already having carve-outs being in that manner prepared that the flexibility of the different business units can be actually act way faster in the market, but as well can be actually be more flexible and faster being sold is increasing dramatically their value. But this is something, if you need before carve-out more than a year to prepare your deal, you will actually be not in the right time on the deal. So this is something where we really see that right now as a big trend in the market, to prepare it more in advance, to set up the business that it's more flexible and being more capable to act towards the European market.
Thanks for coming on the show, both. Where can listeners find more of the work you guys do?
If you go to PWC.com and put there either automotive or performance and restructuring, you will find also in our newsletter there a lot of the insights, facts and figures, what we were talking about today. And if you have any questions, just reach out by email or via LinkedIn. Happy to get in contact.
Yeah, same for me. Just go to the Willkie.com webpage. There's a lot of insights there. Of course, our bios and our team. And if anything is popping up, just shoot us an email or give us a call.
Thanks for coming on the show, Daniel and Hendrik. I really appreciate it. And thanks to everybody listening and watching to Fixed and Floating, the Credit Podcast. If you enjoyed this episode, please follow or subscribe wherever you get your podcasts, and see you next time.